So it's the afternoon of May 22nd, and the House of Representatives has passed what is being called the One Big Beautiful Bill. This is the tax legislation we've been hearing about, and it has some significant implications. I'm going to go through a high-level overview of what's in here for you. And the first thing I want to say, though, is this has not been made law. It still has to go to the Senate. What passes the Senate most likely is going to be somewhat different than what passed the House. And I'm not a political science expert, but I think that then it goes back to the House, or there's some sort of reconciliation process. The House has to pass the bill again, and then it potentially gets to the president for signature. So we do not know what the actual specifics of this tax bill will be until it is sent to the president to sign and he signs it into law. So at this point, we have a bill that has been passed by the House. And at that point, I think that it's close enough that we can talk about what's in this, because even though there will very likely be some changes, this gives us a more solid framework for what to expect. So, of course, I'll get another video out to you once this actually passes and we have a solid tax law that we could make planning and decisions and strategy based around. But at this point, this video is for general awareness so that you're not just completely blindsided down the road when a actual bill gets signed into law, which one probably will. Getting it through the House was a huge hurdle. And so let's go through what's in it as it is right now. But keep in mind that a lot of these things could change, but this is still going to be fairly close to what the final bill ends up being. So there's a lot of individual provisions in this bill. A lot of it is extending the Tax Cuts and Jobs Act. So Tax Cuts and Jobs Act was passed at the end of 2017. It took effect in 2018. A lot of the individual provisions were available from 2018 through 2025. And without a bill like this or some sort of extension, a lot of those individual tax laws do expire at the end of this year, at the end of 2025. So what this bill, as passed by the House, would do, the child tax credit, which is at $2,000, it was increased for TCJA, Tax Cuts and Jobs Act, in 2018. It would permanently keep that increase, which is at $2,000. So it would keep us where we're at as of today. It would extend that. It would also temporarily increase that to $2,500 per child for tax years 2025 through 2028. And then from then forward, it would go back down to $2,000, but it also would be inflation adjusted. So it would go up each year based on an inflation adjustment. There are energy credits, energy efficient home improvement credits, like the solar tax credit, the energy efficient home improvement credit is like your windows and doors and a couple of other items that fall into that. The residential clean energy credit, that one is the solar tax credit. The used clean vehicle credit, which is pretty new. So that's for EV cars that are used. There's also the clean vehicle credit for new cars. Well, a lot of those are set to be terminated starting in year 2026. And then the new clean vehicle credit is significantly restricted for 26 and terminated in tax year 27. So under this, and if some sort of version of this makes it, then, after 2025, there's not going to be as much available in terms of electric, energy efficient home improvement or vehicle credits. So something to definitely keep an eye on and be aware of once this bill passes, if that makes it, is, this could be the last year to do some of those things under this current legislation. The estate tax exemption was increased significantly under the Tax Cuts and Jobs Act, and this would reset it to $15 million. I believe that's the single rate, so it would be $30 million for a couple, so $15 million per person. And that is really significant. Without this extension, that would go back down to around $6 million. HSAs, they're changing the health savings accounts around a little bit. So changing it to where families, singles under $75,000 of AGI, married couples under $150,000 can contribute double the current HSA limit to that. And then some other changes too, including what plans might qualify for that, and some of the limits and what you can spend the HSA money on, such as fitness expenses and gym memberships, could potentially come into play if that makes it to the final bill. There's a provision in here about international money transfers. I don't think any of my clients necessarily have to deal with that, but there's an excise tax when you're transferring money from the U.S. to a recipient of a foreign country. Mortgage interest deduction, so that got limited. If your mortgage is above $750,000, you can't deduct all of your mortgage interest. It used to be $1.1 million. They dropped it to $750,000. This would extend that, and I think also, no, I don't see any mention of adjusting that for inflation year after year. Overtime. So for tax years 25 through 28, there's a new below-the-line individual deduction for qualified overtime compensation. So employees with earned income exceeding the highly compensated employee threshold and qualified tips are not eligible for this, but there'd be some sort of deduction potentially for being paid overtime. The personal casualty losses that were disallowed under TCJA, that would be continued. So no personal casualty losses, that would be extended, and only those in connection with a federal disaster are allowed. There's a new senior citizen deduction. So for tax years 25 through 28, this is a temporary one. Taxpayers age 65 or older could deduct an extra $4,000 from their taxable income. And that does phase out over AGI limits over $150,000 or $75,000 for an individual. The standard deduction would permanently be extended at the higher rate that it's currently at. And also there would be a temporary increase of $1,000 for individuals, $2,000 for joint filers from 25 through 28. So again, permanent extension of what we've had for the last several years, but then a temporary increase from 25 through 28. So there's a couple of things like that: child tax credit, standard deduction, a few of these things where it's a permanent extension of what we've already had, and then an increase in it for the next 4 years. The SALT deduction, state and local taxes, so that is capped at $10,000. If you itemize, that would go to $40,000, and so that would be quite a bit higher for folks who are paying higher state taxes. That cap of $40,000 would be set as a permanent cap. And then the thresholds, so it starts to phase out how much you can actually deduct if your modified AGI is above $500,000, and then that threshold would increase annually for 10 years apparently. The current tax rates that we have, so the tax brackets were a big part of what changed in the Tax Cuts and Jobs Act, and those new tax brackets would be permanently extended beginning in tax year 2026. And also, there's an additional year of inflation adjustment for all income brackets for some reason, except for the 37% bracket. So there are some provisions that the Tax Cuts and Jobs Act terminated, and this is extending their termination. So it's making the termination permanent. The exemptions. So personal exemptions were done away with under Tax Cuts and Jobs Act, and they would permanently be done away with under this bill. Miscellaneous itemized deductions like unreimbursed employee business expenses. Any of the other ones that were miscellaneous itemized deductions subject to 2% AGI floor, those are all permanently terminated. Moving expenses deduction. So when you moved, you used to be able to deduct those expenses if you had to pay for them, or if your employer paid for them, you could exclude them from your income up to the amount you spent on the move. That is permanently terminated under this new tax bill too. There's a new tip deduction. So for tax years 2025 through 2028, there's a below-the-line individual deduction for qualified tips. Basically, if your income is too high, or if you're in a business that does not customarily receive tips, you can't start receiving tips now. So it only applies to those industries where it was custom for tips to be paid before this bill was put into place. And so there's no loophole going to be had by switching your income to be tipped income. This is only for people who are already receiving tips, basically. And that is a temporary one, 2025 through 2028. A few of the business provisions that definitely applies to some clients as well and to a lot of people out there. The 199A, this is the QBI or Qualified Business Income Deduction, that would be made permanent. And the rate would actually increase from 20% to 23% in terms of what you're allowed to deduct from your taxable income. This is huge for anyone with a small business, anyone with a Schedule C, self-employed sole proprietor business, anyone with a pass-through business, S corporation, partnership income. This is a huge deduction, and seeing this extended would be great. And then it's also being increased from 20% to 23%, and that's being made permanent. Bonus depreciation, this is a huge one that people have been talking about. It's been phasing out. Right now, it's currently at 40%, but this proposal restores it to 100% bonus depreciation. So anything that qualifies for bonus depreciation, you could write off 100% in the first year, and that is for any assets placed in service after January 19th, 2025, and it's in place until 2030. So again, this is a temporary extension of bonus depreciation, not permanent. Now, this is a great one right here. 1099 reporting. So 1099K is a report that you would get from like PayPal or your credit card merchant account if you're a business. A lot of individuals who have been selling things on like eBay ended up getting some of these because they dropped the limit to $600. Well, this bill would remove that limit and put it back where it was. So you don't get a 1099K if the income reported is less than $20,000 or less than 200 transactions. So a lot of individuals getting 1099Ks when they really shouldn't have been. That would go away under this because that limit would be put back where it should be, up around $20,000. And then also starting in year 2026, the normal 1099 miscellaneous 1099 NEC reporting threshold is increased from $600 to $2,000 and adjusted for inflation going forward. So that's a great one too, because that $600 limit for issuing 1099s to folks was never pegged for inflation. So it's been $600 for decades, and getting that up to $2,000 is great. And then also tying it to inflation moving forward is great. Now, qualified opportunity zones, I don't have any clients particularly that did any of these that I can recall, but they are going to open up a new round of those where they're authorized starting in tax year 2027 through 2023. There's a new way for pass-through entity tax to be separately stated. I don't have the details on that one, so I'm not exactly sure how that one's going to play out in reality if it stays in the bill to the end. But that, I think, would negate some of the pass-through entity tax strategies that people have been using on S corporations and partnerships in order to be able to deduct state income taxes, even though there's the SALT cap. That, I think, is going to negate some of those planning opportunities. There's hundreds, apparently, of actual like tax law changes in this bill, but those are the ones that apply to the vast majority of people. The other stuff is all pretty obscure, applies to either, businesses. I haven't even looked at the actual bill. I haven't looked at a full summary, but this is from a update service that I get myself from a CPE provider, and going through what is the most common provisions of this tax bill that will touch the most amount of people. So for my clients, this is probably a rundown of what is currently in the bill that would affect you. And from a tax perspective, I don't know what else is in the bill from other perspectives, but there's new funding. I know that there's a new limit for what the national debt can be. So all of that, it all affects us. But from a tax perspective, which is what I cover, this is what would affect your personal taxes, your small business taxes. And again, just remember, this is a general overview for you to be aware of some of the things that are probably going to be in the final bill, just so you start to think through this and you start to be able to plan a little bit around what might happen. We're getting a little bit closer now. House has passed it. It's going to go through the Senate. It's going to change. It's going to be a reconciliation bill. I'm not a political expert, but at this point, I would think that we probably are going to get something passed within the next, I don't even know, weeks to months, possibly. But just keep an eye out on this, and I will send out another video once we actually know what's in the final law, if one does get signed this year.